Today, we're diving into an investment analysis on Centrus Energy, or LEU, which makes the case for the stock to, quote, explode in 2026 thanks to the nuclear supercycle and the AI energy crisis.
Okay, so getting right into it, the analysis does a really good job of framing Centrus as this critical choke point.
Yeah, it does. It hinges the whole argument on two things: the HLU monopoly and then all those geopolitical tailwinds from, the Russian uranium ban.
And I like that it highlights the financial bedrock that reported $1.6 billion in cash post-raise. I mean, that's a serious war chest.
For sure. It's the foundation they need if they're going to scale up to meet all that AI data center demand.
The structure is smart, too. It separates the big macro picture, like the AI crisis, from the company-specific stuff, the microcatalysts, like HALU contracts. It builds a solid case.
It does. It's a very high-conviction thesis, especially with the government push for energy independence.
That's clearly laid out. I wonder, though, if we've considered how robust the immediate connection is between the massive AI energy demand, which is happening now, and Centrus's specialized HALU product, which is really about 2026.
Ah, the timing issue. Yeah. How do you bridge that gap?
Well, that's the first big point. The analysis needs to strengthen the causal link between the broad AI energy crisis driver and the specific 2026 ramp-up timeline for HALU.
Okay, so what's the weakness there, specifically?
The weakness is a potential timing disconnect. The report does a great job establishing the macro problem. It cites the Microsoft deal, the need for baseload power right now. But then the next section on the HALU mode is all about next-gen small modular reactors, SMRs, which are coming online closer to 2026.
And HALU is fuel for those SMRs, not the existing reactors.
Exactly. So that immediate surge in energy demand from AI could, in theory, just be met by existing reactors using traditional fuel.
Which means the big, flashy AI catalyst doesn't actually connect to the Centrus explosion in 2026 thesis? At least not directly.
Precisely. So the suggestion is to introduce data or projections that explicitly bridge that gap.
Show your work, basically.
Yeah. Show when the traditional LEU fuel supply is expected to get saturated. That's what would force the rapid deployment of these HALU-dependent SMRs and justify that 2026 timeline being driven by AI.
You're moving the argument from HALU is important eventually to HALU's the only solution by 2026.
That's the key. For a concrete example, you could introduce specific timelines for the first SMR pilot projects that will actually need HALID LU from Centrus. You gotta move beyond the vague term commercialization.
And quantify the demand?
Absolutely. Analyze the projected HALID LU tonnage that will be required by 2026 for those specific U.S. reactors. That puts a number on it. It connects the macro AI demand directly to Centrus's microsupply in a measurable way.
Okay, that makes sense. So tying fundamentals to a specific timeline. Now let's pivot. Let's look closely at the section discussing the technical analysis and the explosion pattern setup.
Right, because for a report with a title like Explode, the TA has to be rock solid.
It really does. So the technical analysis used to validate the explosive potential needs greater specificity and tighter integration with the powerful fundamental catalysts already presented.
And the weakness is, well, it's just too brief. It's leaning on really general concepts like parabolic run, consolidation, and just holding the $260 support.
It feels a little generic, like you could apply that chart reading to dozens of stocks.
Exactly. It's standing in isolation. It doesn't actually confirm that the market is starting to price in all those geopolitical or HLU milestones we just talked about.
So what's the suggestion? How do you improve that?
You have to integrate the technical setup directly with the catalysts. The chart should be telling the same story as the fundamentals.
A story of what? Smart money getting in position?
Precisely. They should be looking for technical indicators that confirm volume and volatility are contracting in that $260, $270 range. Because the market is waiting for news, not just because it's cooling off.
So show us the structure underneath the price action.
Yes. For example, they could analyze the volume profile around the stock's old all-time high of $464 to see where institutional accumulation zones are.
To see where the floor is really being built.
Right. If that $260 support level happens to be a historical high-volume node, that's a much stronger signal than just a line on a chart. It shows where big players have decided to defend their positions.
Okay, that gives conviction on the support. What about the next move up?
For that, they need to detail what momentum or breadth indicators would signal the next leg up is for real, not just a short covering bounce.
something beyond just RSI.
Yeah. Look at the accumulation distribution line. If that line is trending up while the price is going sideways in that $260 range, it's a huge tell. It shows that buyers are quietly absorbing shares under the surface. It proves institutional patience.
Okay, so moving from the technicals to maybe the biggest hurdle, the valuation.
That makes sense. Building on that point, we must look at how the report engages with the largest counterargument, the valuation.
The elephant in the room? If a stock is already priced for perfection, the risk goes way up.
And this one is. So, the report needs to proactively address the valuation risk, using the reported financial strength to provide a clear counter-narrative to that high forward PE.
What's the current weakness in how they handle it?
Well, the risk section points out the high forward PE, it's around 74x, and then concludes that Centrus must execute perfectly to justify this premium.
That's not what you want to read right before the conclusion. It basically injects a huge dose of doubt into the whole thesis.
It really does. And what's worse is that huge $1.6 billion cash pile they mentioned earlier as a war chest. It's completely forgotten in this section.
So they have the perfect defense for the execution risk, and they just don't use it.
Right. So the suggestion is to restructure that whole discussion, frame the $1.6 billion cash reserve as a powerful mitigation factor against the execution risk and politics risks.
So the argument becomes the premium is justified because their capital position fundamentally changes the risk-reward.
Exactly. The cash isn't just for growth, it's a defensive shield. It buys them time. It means perfect execution isn't actually required.
It reframes the cash from just a number on the balance sheet to a strategic moat. You can say, yes, it's 74 times earnings, but they can afford 2 years of delays without diluting shareholders.
That's the move. And for a concrete example, they should actually model the operational runway that cash provides. Show, in years, how much inefficiency or delay that war chest can cover. It immediately lowers the stakes.
And what about the multiple itself? How do you justify that number, even with the cash?
They need to argue why Centrus deserves a structural premium. Compare that Evercore $390 price target to the growth rate needed to sustain a 74x multiple, and then explain why being the only licensed HALU producer in the West gives them that right.
It's not a normal energy stock.
It's a national security infrastructure monopoly. And that kind of monopoly, with that kind of pricing power, justifies a multiple that other companies in the sector could never dream of.
So, to wrap up, the analysis has a really compelling case here.